Hey folks, today's video is going to be your ticket to the retirement savings party, and trust me, you won't want to miss it. We're talking about the Secure 2.0 Act. We're going to cover the enhanced catch-up contributions for older taxpayers, a controversial change for higher income participants, concerns and administrative challenges, how the IRS is transitioning this, and how you can plan for the future. Imagine this, you're in the age group of 60 to 63, and suddenly there's a golden opportunity to give your retirement savings an extra boost with enhanced catch-up contributions. It's like giving your future self a high five. But, and there's always a but, the IRS has thrown in a twist for the higher income squad. Don't worry though, we've got the lowdown, and it's not as intimidating as it sounds. Now here's the scoop. The IRS, being the good sport it is, hit the pause button on one of those changes due to a chorus of objections from every corner. So, if you're not a fan of surprises, you'll appreciate this one. In today's video, we're going to break down the Secure 2.0 updates in a way that's more like a friendly chat than a finance lecture. We're talking about your hard-earned money after all. It should be fun, right? Get ready for a significant overhaul in 401k catch-up contributions, a massive change courtesy of the Secure Act 2.0. I've got the details on what this means for you. Let's dive into the exciting world of Secure 2.0. Alright, let's talk about some cool ways to boost your retirement savings without getting lost in the financial lingo. So, if you're 50 or older and rocking an employer-sponsored 401k, 403b, or 457b plan, here's the scoop. You can throw in some extra cash, aka catch-up contributions, on top of your regular contributions. Now these catch-up contributions are like your secret weapon, giving you an extra edge. For 2023, your regular contributions are capped at $22,500, and that number adjusts for inflation down the road. But wait, there's more. You can toss in an extra $7,500 as a catch-up contribution. It's like leveling up your retirement game. You're in the simple IRA plan squad. Your standard max contribution for 2023 is $15,500, adjusting for inflation in the future. Now here's the cool part. If you're 50 or older, you get to add an extra $3,500 as a catch-up contribution for 2023. Think of it as your retirement savings power-up move. Now, why bother with these catch-up contributions? Well, they're not just a numbers game. By making these moves, you're not only reducing your taxable salary or income if you're a self-employed sole proprietor, but you're also giving your tax advantage retirement account a little extra love. So, there you have it, the lowdown on catching up with your retirement savings in a way that won't make your head spin. Now, let's talk about some exciting news for our future retiree rock stars. Starting in 2025, Secure 2.0 is bringing in some awesome changes, especially if you're hitting that sweet spot between ages 60 and 63. For all you retirement plan champs in that age range, Secure 2.0 is cranking up the maximum catch-up contribution game. Get this, it's going to be the greater of $10,000, adjusting for inflation of course, or a whopping 150% of the max regular catch-up contribution allowed in 2024. Yeah, you heard that right, 2024, not a typo. Now if you're rocking a simple IRA and fall into the 60 to 63 age bracket in 2025, Secure 2.0 has got your back too. Your max catch-up contribution will be the greater of $5,000 or 150% of the regular catch-up contribution allowed in 2025. No typos here either. Quick heads up, these super catch-up contributions are like a birthday gift, but only if you hit the big 60, 61, 62 or 63 during that year. If not, no worries. The regular catch-up contribution limits we chatted about earlier will still apply. So, whether you're eyeing 2024 or 2025, Secure 2.0 is adding some extra sparkle to your retirement plans. Buckle up, because we're now diving into a bit of controversy with Secure 2.0. So there was this change in the pipeline set for 2024, but guess what? It got hit with so much pushback that the IRS hit the brakes and postponed the whole thing. Now here's the scoop on the change. For folks in employer-sponsored 401k, 403b, and 457b plans, if your FICA wages from the previous year soared above $145,000, you were supposed to make catch-up contributions only to a designated Roth account set up by the plan. Now, these designated Roth account contributions are after tax, so they won't be doing any magic on your taxable wages. But hold up, there's a silver lining. The balances in these accounts can grow tax-free, and qualified distributions from them are also tax-free. What's a qualified distribution, you ask? It's one that happens at least 5 years after your first contribution to the Roth account and is made after you hit the golden age of 59 and a half, or due to disability, or sadly, in the event of death. Here's the key nugget. If you're a partner or rocking the solo 401k plan as a sole proprietor, you're in the clear. This change doesn't play in your sandbox since you don't deal with FICA wages. So, let's the lowdown on the controversial Secure 2.0 change that's got everyone talking. Now let's talk about the designated Roth account change in Secure 2.0. Not everyone's throwing a party for this one. The looming 2024 effective date for this change is causing a bit of stress for both employees and employers, and here's why. First off, employers need to play detective and figure out which employees have wages above that 145,000 mark. Then they've got to pass that info on to the plan administrators and talk about some paperwork gymnastics. Next up, there's this whole dance of setting up procedures to limit catch-up contributions for affected employees to designated Roth accounts. And guess what? They've got to explain this whole new deal to the employees caught up in the mix. Communication game is strong, but it's still a hurdle. But here's the kicker. Not all employer plans are currently offering the designated Roth account option. Now, with this change, employees are likely going to raise their hands and say, hey, we want that option. This means employers might need to tweak their plans to keep everyone happy. Without these adjustments, affected employees won't be able to make any catch-up contributions. Alright folks, good news on the horizon. In response to the collective concerns, the IRS has thrown us a lifeline in the form of what they're calling an administrative transition period. So let's break it down. During this transition period, the effective date for the designated Roth account catch-up contribution change was pushed back, and now it's not hitting until January 1st, 2026. But what does that mean for us? Well, we get to kick back and ignore this change for now, meaning the status quo stays put for 2024 and 2025. Whew, right? Catch-up contributions can continue. Now, here's a little side note for you. The IRS, being the cool problem solver it is, also tackled an embarrassing drafting glitch in the Secure 2.0 language. There was this weird hiccup that seemed to wipe out the ability to make any catch-up contributions after 2023. But fear not, the IRS stepped in with Information Release 2023-155, setting the record straight. So if you're 50 or older, you're in the clear to keep making catch-up contributions in 2024 and beyond. They've got our back. And hey, the wonky statutory language, they're planning to fix it up in a future technical corrections bill. Crisis averted. Guys, life comes with a mix of good and not so good news, and the tax-saving catch-up contribution privilege is no exception. The silver lining? Well, the delayed effective date for the controversial designated Roth account catch-up contribution change is a breath of fresh air. We've got some time to wrap our heads around it and figure out how to make it work in our favor. But here's the reality check. The change is still on the calendar and is set to kick in on January 1st, 2026. If you're steering the ship of a 401k plan for your employees, it might be a good idea to start plotting your course sooner rather than later. Procedures and plan amendments may be on the horizon to ensure smooth sailing and compliance with the change. Now, navigating through administrative hassles might not be the highlight of your day, but here's the upside. The designated Roth account option could be a game changer for higher income employees, and yes, that includes you. So it might be worth the effort. Hit the subscribe button if you're ready to tackle the good and not so good in the world of tax and finance, and let's stay on top of these changes together.